Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode, we're going to talk about interest rates again. So it's a topic we cover quite frequently for obvious reasons. It's forever a moving outlook. And I thought, given some of the recent news, that it would be wise to just look again at what this means in terms of a future outlook of interest rates going forward. So yeah, let's dive straight into it then. So obviously over the last few weeks, we've had some encouraging news. Inflation is coming lower than expected. We'll go into that in a little bit. The Middle East conflict, obviously there's been the signing of the agreement. So there should, in theory, be a truce. We'll wait and see how that plays out. Oil prices have come down from their highs. And naturally, people are starting to ask the question, obviously, does that mean that interest rates are actually going to start to come down? And more importantly, then, what does that actually mean for property investors and what's next? So let's have a look then. So one of the rates that we're aware of is the Bank of England base rate. Okay, so the decision today was to hold the interest rate. So I think we're probably closer to the top of that interest rate rather than the bottom of it. So I think there is room for that to move. The risk for further increases has reduced. So I don't think that it's going to come down necessarily in any time soon, or it's not going to come down in the next time we meet, I don't believe. However, the chance of it going up has certainly reduced, which is a good thing. We're not about to return to an era of low interest rates that we had pre-COVID and all of that we had previous. And that's all as long as inflation continues to behave itself, as I say, coming a bit lower than anticipated. So that's obviously encouraged the Bank of England to hold the rates. It's worth noting that the vote wasn't unanimous. There were two individuals that voted to increase the rate. So it's not that straightforward, as you can imagine, but it's certainly a bit more encouraging. And it's probably the right thing to do, in my view, in terms of what's going on with energy prices and so on and so forth. So my expectation for the rest of 2026 is for it to stabilize. So I don't foresee any aggressive cuts. We may see a 0.25% drop maybe in favor. If it were to go up, again, I don't see anything major happening in terms of that. Again, another 0.25% either way. It's probably where we're going to be, but I think we're going to be largely stable for the remainder of 2026 on that front. But as we know, mortgage rates aren't just about the Bank of England base rate. There is the swap market that we talk about a lot as well. So just because the interest rate has stayed stable with the Bank of England, that doesn't automatically mean that that's going to find its way into the swap market. And we're talking the swap market influences the fixed rates and the discounted rates out there as well, which most investors will find themselves on. So lenders price the rates based off of the swap rates, okay, which loosely tracks the Bank of England base rate. If you put a graph next side by side, you'll see that there is some volatility across the two, but largely speaking, they do tend to follow one another. So when we get asked about interest rates, we obviously keep one eye on the base rate, but we also keep a bigger eye probably on the swap markets, because that's what we find will influence the interest rates that you find in your mortgages. We've gone over swap rates a lot. I won't dwell on it too much. If you are curious as to what swap rates are, have a look at our previous episodes. But it's really a swap rate is a rate that tries to predict the future. So when you fix money for 2 years or you fix money for 5 years, you're trying to guess what the market's going to do over that period. So you can lock in the margin for that time, and then you can lend it out to customers and so on and so forth. Okay, but we've done extensive episodes on this. So have a look at previous episodes to go into detail on what that means in terms of the swap market. So again, I think that's probably going to find some stability in there. What we've seen is that 2-year fixed and 5-year fixed are very similar in pricing. Traditionally, or in a stable environment, you would see the 2-year fixed rate to be cheaper than the 5-year fixed rate. So what that's actually telling us is that the 5-year outlook is more stable than the 2-year outlook. And therefore, they're having to price in more volatility into the 2-year fixed than they are into the 5-year fixed. And that's why we're seeing that shift. We have actually seen it being the other way around over some periods as well. So that's what you'll see at the moment. Okay. And I think that will continue to remain relatively stable. In fact, we are seeing some rate cuts at the moment from some of the lenders. So some of the knee-jerk, or some of the fallout, if that's the right word, from this truce means that some of the lending will drop and then it will just plateau, I think, really. So we'll see some rates come down shortly and then plateau out for the remainder of the year, assuming nothing else happens, of course. Okay. One risk, though, that I do think is being underestimated. Well, actually, let's go back to the other consequence of what's happening in the Middle East and why inflation is the way it is. And the reason for that is because of oil. So we've all known that the energy prices have gone through the roof recently. If you, like me, have turned up to a petrol pump and had a look at the price of diesel, the price of petrol, and see it bouncing all over the place, almost like the swap market, yeah, it's infuriating. So you can see exactly what's going on with the Middle East conflict and what that's doing to our oil prices, and that's finding its way into energy costs, transportation costs, and everything else like that. That will then drive up the cost of goods overall, and that's where we were expecting to see higher inflation. Inflation hasn't come in quite as high as we anticipated, so that's a good news. But these are things that we'll find, and this can stifle economic growth. Again, we've had conversations around the Bank of England base rate and how useful of an instrument that is to control inflation and whether it is or isn't. That's probably an episode in itself. But yeah, these are the things that we're seeing. But I think one thing that is probably being underestimated in the markets is the issue that we have had around fertilizer. Now, the Strait of Hormuz was closed or restricted, whichever news you follow. But one of the things it did was restrict the movement of fertilizer. A lot of it goes through the Strait of Hormuz. What that then meant, obviously, that wasn't going to various parts of the world. And therefore, that is ultimately going to impact harvest. So some people weren't getting the right fertilizer. They had to reduce the crops and so on and so forth. So I think something that we will see next year, which will inevitably find itself into inflation, food inflation, is that actually harvests are likely to be impacted as a result of the Strait of Hormuz. And as such, then there will be a tightening in the markets, supply versus demand, etc. And we'll see that food prices may actually go up as a direct result of that. So I think that's a bit of a lag in the system because obviously you get harvests and it's an annual thing. You can't just decide not to grow more. It's seasonal and so on and so forth. So I think that is something that we need to keep an eye on for 2027 for sure. We've also got an element of political uncertainty ahead of us. There is likely to be a leadership challenge. Now, what that looks like exactly is hard to say. So I don't believe we'll see a change in government necessarily, but we will see a change in leadership. And then it depends what the new person brings in with them in terms of their policies and what they can get their backbenchers to approve and so on and so forth. So with that, whilst I don't see any major changes in the short term, what it does do is, again, create that little instability in terms of if somebody else is going to come in with slightly different policies, what does that mean to the overall outlook and so on and so forth. So everybody wants everything to be stable. It's easy to predict. That's where interest rates tend to be easy to control. And I think that might find its way into the process as well. Now, that may be later on this year. It depends, as I say, it's not cut and dry. I don't follow politics particularly closely, but big events like this are certainly something to keep an eye on. That's for sure. So what are my views on this? I've covered some of the things I think will influence interest rates over the near term and into 2027 and throughout. Then I think further increases is unlikely. I think we will just see that if it doesn't come down, it'll just typically stay where it is. If we do see any increases, they're going to be nominal. When I say nominal, we tend to see increases or changes in rates at 0.25%. So that's something to bear in mind as well. I don't think we're going to see anything dramatic. So just bearing in mind, a 0.25% change in an interest rate is obviously relevant to the size of the loan. So if you've got a smaller mortgage, then a 0.25% change is negligible. If you've got a bigger mortgage, it's going to find its way into that. You're going to feel the pinch a little bit more. And also remember, this is really a conversation for a certain landlord that has a certain event happening. Either they are buying new property, or they're having to remortgage, i.e. come out of their fixed rate, or they want to raise some capital or do something like that. So this is an event-driven conversation, okay? This is not going to impact those individuals that are 2 years into a 5-year fixed, in my view, okay? There's more that's going to happen over the next 3 to 4 years that is going to influence all of that, of course, okay? I certainly don't think we're going to end up down at 1% mortgages again. I think that those days are long gone. I don't think we'll be coming back to them anytime soon unless there's other macroeconomic events. We understand the trigger point to that was both the financial crisis and September 11, if you recall. So those are the bits when interest rates really started to fall. So I don't think we're going to get anywhere near that again. I think changes, as I say, will be incremental. They'll be slow. We went through a period, if you recall, where interest rates were changing almost every time they met. It was going up another 0.25% and another 0.25%. And it was really hard to keep pace with it. So I don't think we'll see that again either in the short term. And I think we will see, I've mentioned what I think is going to happen in terms of food inflation. Now that is one lever, or that is one metric that will influence the inflation figure. If energy prices are back under control, then arguably something like food inflation will have less of an impact in the overall inflation number. So I just highlight that as something that I think has got a slight sting in the tail and something that has been slightly underestimated on that. So my view, as I say, a degree of stability. We've gone through the tumultuous time that was sort of 6 to 8 weeks ago, where rates were changing all over the place when the conflict first started. You probably noticed the same as I did that when it first started, it was in the press. Everything was about the conflict. Then it sort of moved aside and moved on to other topics and other stories, and we heard less around the interest rates and so on. So I do think what the media presents will often drive some of this behaviour as well. So just bear that in mind. So 2026 is likely to hold. 2027, I think we are likely to see some sort of change in leadership, or the leadership change will have changed and we'll understand what that policies are going to look like going forward. I think that might have an impact into 2027. But again, I don't think that's going to be any significant movement either way. The key driver to this is ultimately going to be inflation. So if you really want to see where the world is going, the number you probably want to follow the closest is, what are the inflation figures? Are they meeting the 2% target? Are they increasing? Are they getting out of control? Straight after COVID, they're up as high as 10%, or real inflation up as high as 10%, and that sort of thing. So follow the inflation number. That will give you a good indicator as to what rates is going to look like. And as long as we've got that under control, and that's not getting up into the 3s or 4s, then we're probably going to stay where we are on that front. So there we go. That's my prediction. Probably, if you ask me next week, it'll be totally different because something else would have happened. And as always, these things are always a moving feast. But as of today, given the set of circumstances that's presented to us, that's what I think we're going to see. And we shall see if that pans out. So I hope you found that useful. A bit of an insight into interest rates and what we think is going to happen. Who knows? I'll be right. Only time will tell. But thank you very much for listening. And I will see you in the next episode.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.